Okay, good morning, everybody. I just wanted to thank you for joining, and I hope that everybody is happy and healthy. And thanks for spending, hopefully it's just the next 30 minutes with me as we walk through and talk about this stock rally and what's happening in the market right now. So I'm going to go through most of this rather quickly, and I will say that I have left actually quite a bit off this, but I wanted to keep it somewhat reasonable as far as the amount of time. So one of the things I want to talk about real quick is just want to go through a recap of some of our recent views. So in January, it's interesting, you go back, we did a webinar at the end of January, and we'd had some bullet points that were recommending a defensive positioning. And some of those bullet points were all news is being viewed positively, stock prices have decoupled from underlying fundamentals, and the Federal Reserve is fueling risk-taking. So, interesting. Then in March, in the middle of the stock market crash, we actually held a video Q&A that led to a few of these takeaways. One was that sentiment and positioning had gotten extremely negative. A very strong rally would come soon. It was still too early to conclude whether this was a new bear market or just a severe correction. And then as we rallied up in May, we actually hedged the portfolios as we thought the rally went too far and that fundamentals needed time to catch up. So that's the views over the last 5 months or so. But what has changed? And really not much has changed since January if you were to look at stock prices from January to today. Except the only thing that's different is that we have entered a recession. In fact, the NVER declared it on June 8th. Fundamentals have cratered, speculation has run rampant, and fiscal and monetary policy has gone on steroids. So even though prices have not changed, things have changed actually quite significantly. So usually I will walk through and do quite a bit of work on the economy. However, we're actually just going to dedicate one slide to the economy today because really with how quickly things collapsed because of COVID-19, there is just so much uncertainty, and you can't even begin to forecast what's going to happen going forward. But I thought that this chart was interesting. So this goes back to 2007, it's total U.S. employment. As you can see, the drop in between March and May was dramatic. I mean, we gave up all of our gains for the entire bull market as far as jobs. And then what's interesting is when you look at this and you put it into perspective, last Friday we had a 10 million person surprise. So expectations were for 7.5 million of job losses again, and we had 2.5 million in job gains. And that caused the stock market to move higher by 3%. After stocks had already rallied 40% off the bottoms. And so I can understand the optimism because things are not getting worse, but we need to put this into perspective of really how far and how bad this has been for the economy. And so it's just important to know going forward that I don't think anybody can really predict with any type of certainty what's going to happen, especially over the next, I'll say, 6 to 12 months. So what we're going to focus on a lot more today is about sentiment, is about positioning, and about a lot of the other things that are going on in the market outside of the economy. So one of the questions is, was March 23rd really the bottom? And as it happened, a lot of people were talking about, okay, we're going to get a reflex rally, one of the things that we were expecting. Then you're going to get a retest of the lows, and if we do, then that should mark a bottom and we'll move higher. Well, since the lows, we've done nothing but really go straight up since March 23rd. And one of the things that's interesting is that, if you look at and you go back to what we were talking about in our March call, was we can't really justify whether this is a correction or the bull market ended. And one of the questions that I have still is, did the bull market actually end in February and bottom in March? Because traditionally a bear market is considered 20% downturn in stock market. But I believe this is actually just more arbitrary in thinking that 20% is downside. If you do 30% downside and then come back by 40% and stock prices are unchanged in a matter of a couple months, is that really a bear market? Because nobody really experienced the pain. It happened too quickly for it really to be a bear market. So that's why I think this chart is rather interesting and still leaves up some room for interpretation. Either this is the beginning of the bear market and this rally was just a historic rebound rally, or the bull market never ended. And again, I'm going to say I still think that's to be determined. Now, one of the things that's interesting in this chart on the bottom here is this goes all the way back to 1949 and looks at new bull markets that happened after bear markets. It has 8 different indicators on what that is. And so of what happens at those bottoms. And the first couple are valuation, then it's momentum, then it's divergence, then it's new lows, transport's outperforming, utilities underperforming, and a breadth thrust. And we'll get more into what a breadth thrust means on the up leg. What's interesting is in every new bull market that we've had, going back to 1949, at least 5 of those 8 conditions were met. And in many cases, 8 of the 8 conditions were met, especially if you go back to the last one in 2009, which I would consider a generational bottom. In this case, on March 23rd, 0 of those conditions were met. Very interesting. Also, when we want to look at bottoms, valuation is an important component of a long-term bottom. And the reason why it's important is because valuations, all they really do, valuations are terrible. They're terrible for short-term indications of what the stock market does, because things can stay cheap and things can stay expensive for a long period of time. However, when you go out and look further, valuations are a great indicator, because what it does is it provides you a margin of error. When valuations are expensive, there is very little room for error. When valuations are cheap, there is a lot of room for error, so it puts the odds in your favor. It increases the risk-reward. It increases the reward versus the risk, and vice versa when valuations are expensive. Now, if you go back all the way to the 1960s, the red bars indicate where the recessions are. The blue line is total market cap to GDP, so it's a measure of valuation, and it's one of Warren Buffett's favorite measures. What's interesting, let's go back. The bottom in the recession in the late 1960s, 35% of GDP. In the 80s, 33% of GDP. In the early 90s, 47% of GDP. The early 2000s, again, and this is coming off of the dot-com bubble, it was 71% of GDP. Then you had the financial crisis, which was 51% of GDP. And all of this is indicative of very, very cheap valuations. Now you go back, and all of these occurred within a recession or after a recession. So go back to December of 2018. Again, this was a 20% correction that bottomed and then moved to new all-time highs. We were at 123% of GDP. So again, this didn't occur within a recession, so that makes sense. Now we've got the March 23rd bottom, which was almost exactly the same at 120% of GDP as what we saw in December of 2018, and that bottomed. Now we just got confirmation that we are in a recession right now. So we bottomed at a significantly higher valuation during recession than any other previous recession. Just again, interesting, something that's never happened before. So another thing when you talk about bottoms is the breadth thrust. And again, what that means is breadth usually leads price. And that's in many cases. That's at tops and at bottoms. When we're talking about looking for a bottom, what this means is you want to see more stocks participate, especially on the cyclical side, meaning the economic sensitive stocks should start to bottom before stock prices bottom. So this here is the gray line is the S&P 500, and these green lines on the bottom are indicators of breadth. So higher numbers show breadth. So each one of the, and this just goes back to 2008. So as you can see, the bottom in 2009 had a huge breadth thrust. The bottom in 2011 had a big one. The bottom in 2012 had a big breadth thrust. The bottom in 2016 did. Even right after the election, the correction before the election in 2016 had a breadth thrust. Go back to December of 2018, had a breadth thrust. Almost simultaneous as stocks bottomed, you had more breadth that came out of the market, meaning more stocks were participating. What's interesting is, if you look here, yes, breadth has started to get better, but that's after a 42% move in stocks. Look at all the previous moves, ones in this bull market: 19%, 9%, 16%, 17%, 18%, 26%. So this one is almost double, or in some cases bigger, than all of the other previous moves off of significant corrections with worse breadth. In fact, it wasn't until the last couple of weeks that you had some of the more cyclical names that were starting to participate in this rally. So if that's the case, then why has the rebound been so strong? And what's happening now, and something I've seen more than ever, is the famous moniker, which is "this time is different." In fact, we have never had a Federal Reserve take rates to zero while also doing quantitative easing, using the repo, buying corporate bonds, buying high-yield bonds, and doing a Main Street lending facility at the same time. You couple that with the government, which is doing a CARES Act, a PPP loan, and increasing unemployment benefits at the same time. So that's different. We've never had an economy that was completely shut down. So the economy can't get any worse than it was in April and May. And the last thing, which is, as the market is rebounding, I've seen more and more that the stock market is not the economy, which I agree, it isn't the economy. But there is a pretty big correlation between what the economy does and what the stock market does. So, another way that this is different is, this is one of my favorite charts, and I've used this in the past because it looks at sentiment. And one of the things that's happening now is, usually when you have a recession and you have euphoric conditions, that takes speculation out of the market because people get scared, people get worried, and they don't want to watch things continue to go down. And again, that's the panic, capitulation, and anger part of it. We never saw that. This happened so quick, that downturn, the exact opposite happened. In fact, we saw even more euphoria. So yeah, in many ways, this is a little bit different, because you don't usually see euphoria happen in the midst of a pretty bad recession. So again, but I'm going to point, I don't think I believe we're still at euphoria here. We are not at this disbelief part right here, which is, this is a suckers rally. Yeah, and I know there's some people that say this is still a suckers rally, including myself. However, you have to look at not necessarily what people say, but how they act and what they're doing. And that's what we're going to get to in the next part of this. So let's talk about retail euphoria. So positioning and sentiment is very, very good indicator at extremes. In fact, we saw very, very high positioning and sentiment in February at the peak, and the exact opposite at the March low. Now we're seeing it again just over the last couple of weeks. And what's interesting is the euphoria now has been driven by retail traders, not with the big money such as Warren Buffett. So what I'm going to show you here, and I'm not sure if you know this person or not, but Barstool Sports is they have done a phenomenal job in building a business. In fact, Dave Portnoy, who is pictured below here, he is the president of Barstool Sports. They sold their business to Penn Gaming for $400 million in late 2019. So they got a good amount of money. This guy he does. So they talk about sports. They talk about a lot of things. They do videos all the time. They have a lot of followers. They have at least 10 million followers on Instagram and Twitter. I know it's more than that, but that's what I could find. What's interesting is in the midst of this downturn, somebody who just received a ton of money and has never traded before and then has a lot of influence, and trust me, if you follow him, he has a lot of influence, has now changed himself to Davey Day Trader Global. So I'm just going to play this for you real quick. So that video was shot and taken and posted to Instagram 2 days ago. That gives you a view of what the general sentiment is and how feverish this speculation is right now. Now, again, I will caveat it. I know the guy he's a marketing person. He's got a lot of followers. He's doing that. It's entertainment, but he's using real money. He's doing that with real money, and that is indicative of what's happening right now. So let's take another look at this retail trader. This is very, very interesting. So this chart looks at a retail index versus a hedge fund index, and it goes back to 2018. As the line goes up, that means the hedge fund is outperforming retail investor. As the line goes down, it means the retail investor is outperforming the hedge fund. What's interesting is that index peaked in November of 2019, and the retail trader has absolutely decimated the hedge fund trader over that period. Now, what's interesting about that, there's a couple of different reasons. One is zero commission trading has just gone through the roof towards the end of last year. Additionally, even though the market wasn't necessarily predicting COVID-19 and how terrible it was going to be, the economy was already worsening. It was already getting significantly worse, and we were on the verge of a recession anyway. And so hedge funds started to pull back just as retail traders really started to ramp up their exposure. And what's interesting, especially if you look at the end here, is the outperformance as a lot of the information and the fundamentals continued to worsen, and hedge funds pulled back even more in the midst of this rally, especially at the last part. What's happened is retail investors have gotten even more aggressive. And so one of the things that's interesting is, one of the things that also makes hedge funds do well over time is their use of leverage. Now, it's a little bit, leverage can come in different ways, but one of the ways that it works is, hedge funds, because they have a lot of money, they're able to borrow at very convenient rates, and they use that borrowed money to buy even more assets, something that many retail investors can't do. And so you can amplify your returns, and that's why if you bet correctly, you can have very significant returns with that leverage. Now, what's interesting, and this chart shows it, is that options are the same type of thing. They are a different form of leverage and something that is readily available to a retail investor. So what an option does, let me just explain it real quickly. If you own a stock and it goes up 5%, you make 5% on that stock. If you own an option on that stock, that same stock goes up 5%, your option will basically double. It'll go up 100%. Now, the reason for that is there's more inputs than just owning that stock. When you own an option, you not only have to be right on the direction, but you also have to be right on the timing, because options expire. They expire weekly, they expire monthly, you can have a longer period of time. So that same person, if you can own a stock, the stock could go sideways and do nothing, and your call option can expire worthless. So if you own the stock, you have 0 return. If you own the option, you have negative 100% return. So you are betting very heavily that this is going to work in your favor, because you could either make a lot of money or lose everything. Now what's interesting is, and if you look, this goes all the way back to 2000. So the black line is the S&P 500. So you can see it's moved up. The blue line is the amount of small trader call options. So this isn't institutional money. This is small trader options. As you can see, it's moved higher. It stayed pretty much the same from 2008 all the way to 2019. And then it started to tick higher throughout 2019 and then exploded higher in early 2020 and then even higher after the downturn in March. So this is something that, again, when you look at it, this is massive speculation. This isn't something where people are debating whether this was the bottom. That was the bottom. We're going full all in. Now, what's even more interesting is, again, another example of why this is not professional speculating. It's not only retail investors, because there's some people that are very, very good investors. They do their homework, they look, they know that they're going to invest for the long term, and they buy their stocks. They don't go on margin, they're not trading options, they're not gambling, they're good investors. What's interesting is if you look at Google Trends, so this goes back to 2004. This is just the Google search for day trading on the blue line and call options on the pink line. So that has stayed pretty much for the last 16 years. It has been pretty much the same. It moves up and down but stays in that same level. Now go to 2020 and all of a sudden the search for day trading and call options is spiking through the roof. So that is not people that have been doing this for a long period of time, but that is telling you these are new traders that are trading for the first time ever and doing it in the most speculative way possible. Again, that's not, to me, that is not a sign of a bottom at all. So one of the things that I say is investing is good, but gambling is dangerous. If you hold good companies for the long term, it is going to pay off. You may have to hold for 15 years or 10 years or 5 years, but if you own a good company, it will get through the recession and they will be better off over the long term because stocks go up. Now, gambling, on the other hand, when you're betting like this, is dangerous. So let's just look at what's happened, again, since June. The pink line is weak balance sheet companies. So these are the worst companies, the worst and most at risk of going bankrupt. The black line is the S&P 500, and the blue line is the strong balance sheet companies. So, again, strong balance sheet meaning they can weather the storm, they can get through the recession, they will be better on the other side. In the midst of a recession, we're not out of this recession whatsoever. I don't care if we did 2.5 million jobs last month. We're still down massively. So we're in the midst of that, and yet you've got almost 13% gain in a little over a week for the weak balance sheet, and versus only a 3% gain if you're invested in the strong companies. That is the opposite of what should be happening. Now, what's interesting about that is, so again, poor balance sheets lead to bankruptcies. If you have too much debt, you can't survive the downturn to see the better times on the other side. So what happens is, and again, I need to explain this, because when a company goes bankrupt, it doesn't mean, and they file for Chapter 11, it doesn't mean they stop doing business. It doesn't necessarily mean they stop doing business. What it means is they can continue to operate, but they have to reorganize the company. And so what that means is every company has different investors. So you have debt investors, you have stock investors, you have loans, you could have private equity, you could have inside, friends and family. There's a number of different ways, and that's what's called the capital stack. So when you do that, so the capital stack is you have the highest, so if a company goes bankrupt, the highest priority gets paid first, and that's going to be your senior secured debt holders. The lowest priority gets paid last when you reorganize that company, and that is going to be your stockholders. So even if a company does not go out of business, a bankruptcy would still wipe out a stockholder, and you will not have a chance to come back. And that's very important to understand. So if you look here, this chart below, we're at the most bankruptcy filings since 2009. Again, not a surprise because we're in the midst of a nasty recession. So, again, this time is different, including bankruptcy. Here's a chart of Hertz after filing for Chapter 11. The stock in 1, 2, 3, 4 days was up 545%. The stock was up 545% in 4 days after they filed for bankruptcy. So again, the stock here is worthless, yet the stock was up 545%. The day before they filed for bankruptcy, the stock was trading at $2.50. So it's almost, and then it went down to about 55 cents and then moved up to $4.53. So again, this stock is trading higher after they already filed for bankruptcy, meaning they have to reorganize the company. Now, there are ways where you can go in and buy distressed assets and do a lot of accounting and calculation to figure out, say, okay, well, the assets in this company, if they go through, because Hertz does have assets, they do hold cars, they can go through and they can sell all those cars, pay off all their debt holders and make them 100% whole and still have money left over for the equity holders. There is a lot of accounting and assumption that needs to go into that. Now, the reason why I'm going to say that that is not being done is if you look at this next chart, this is, the pink line is the price of Hertz, and the green line is the number of Robinhood users that are holding Hertz. Now, I will preface this by saying that I am actually an original investor in Robinhood, the company, and I believe in what they're doing, and I think it's important to be able to bring commission-free trading so that anybody can invest for the long term. Again, investing, not gambling. Now, the reason why this is important to track, and it's pretty cool that you can track these holdings, is it shows, Robinhood, there's no institutional traders on Robinhood. It's 100%. You can have $500 and trade stocks on Robinhood. So it shows, how many people are actually using this. What's also interesting, if you look at this, is it ranks. So you can see number 49 NEO, number 50 Hertz, number 51 Gush, which again is interesting here. NEO is a speculative Chinese, basically it's the speculative Chinese Tesla, and Gush is a triple leveraged oil ETF. So what it's saying here is Hertz is the number 50 most held stock in their entire platform. In their entire platform, Hertz is the number 50 most held stock. And what's interesting is, so again, you look here, this tiny little blip here where it dropped is when they filed for bankruptcy, which there was about 40,000 users that held Hertz. After the bankruptcy, it went from 40,000 people holding it to 160,000 people holding this after the bankruptcy. And I can guarantee you that 120,000 people didn't file through all the different pieces of paper at Hertz and calculate how much their fleet was worth, how much debt was on the balance sheet, and what the actual net asset value of Hertz is when they complete their bankruptcy. So again, this is an example of, okay, yeah, this time it is different. Right now, you've got bankrupt companies that are worthless that are going up 500% in a matter of a couple of days. That is a sign of euphoria, not a loss. And what's interesting is, and I'll just, in this bullet point here, is Carl Icahn, who held 30-some% of Hertz, actually sold at 80 cents. Just like Buffett sold his airlines near the lows, even though they've bounced back significantly. And I will say this again, these are people that have massive amount of money. They have they do a massive amount of due diligence, and they're sitting there not buying more of these shares, but selling after they've already crashed because these investments are virtually worthless, even though the stock price has not shown that over the last several weeks. So, Let me just get to another point. So, okay, so we understand Robinhood. They've opened, millions of new accounts. There's a bunch of new traders, but that is not enough money to move markets. And I will say, of course, it isn't enough money to move markets, but it is an example of how much speculation and frothiness is in here. So, one of the other interesting things is, yes, there are other investors that are in there. So here, this chart below is looking at the NASDAQ. And so this is a daily sentiment index, and it goes back all the way for the entire bull market back to 2009. Every time this sentiment index has gotten extended over 93, we have had significant pullback. So it's happened 1, 2, 3, 4, 5, 6, and this is now the 7th time since 2009. So, it doesn't happen infrequently, but it's pretty rare. After every one of these instances, we've had a drop of 17, 7.5, 12, 12, 8, and 30%. We are now at 94. Now, I'm not saying that it can't go from 94 to 97 or 98 or 100. It's possible. It can. But there is a good chance that when sentiment gets this position that you do get some type of significant correction. And it's just a matter of, is that a significant correction where fundamentals will catch up? Or is it the beginning of another significant leg down that either tests the lows of March or breaks the lows of March? Either way, it just shows that, again, when you go back to that panic euphoria chart, we are much closer to euphoria than we are to capitulation or something where people don't believe the rally. Even if some people are saying it because, I don't understand because we're in a recession. If you look at how they're acting more like euphoria than they are like panic. So another thing I want to talk about is the Fed can only take you so far. And we have rebounded off the lows of March exclusively on multiples. And what that means is people are willing to pay more for stocks now than they were in February. And let's think about that for a second. So in February, before the recession and before COVID-19 hit, we were willing to spend less to own a stock than we are now that we know everything that's happening and how much unknown there is in the economy going forward. It's pretty crazy. So what's interesting here is this below chart looks at profit margins, which is the red line, and the white line is the S&P 500. So the previous two recessions, the tech bust, profit margins and the S&P 500 dropped in lockstep. In the global financial crisis, the stock market and the profit margins dropped in lockstep. The recoveries worked out in lockstep. Now what's interesting is if you look at the peak in profit margins in this cycle, it actually happened and coincided with the December 2018 20% correction. And then what's interesting is at that point in time, there was no recession on the horizon, yet profit margins peaked. And it was, this was just a market event. And maybe it was a little bit more. Maybe it was a little bit more than that, and there was some big money that was taking, long-term investors that were taking money off the table at the peak of profit margins. And what's interesting is, and then once you get to this point, you have the little blip, the downturn in March, and then the bounce back for the last few months, and at the same time profit margins have just collapsed. So there's a gigantic gap between what prices are saying and what profit margins are saying where prices should be. So one of two things has to happen. That gap will close. I guarantee it will close. It's going to close in one of two ways. One, either this is just over and the economy comes roaring back very, very quickly, and profit margins go to new all-time highs very, very rapidly. That's one way. Or two, prices come back down to match up with profit margins, even if profit margins bottom out. So what does this all mean? And I keep going back to the Federal Reserve, and the current view is that you can't fight the Fed. And I think that's just bogus. Additionally, long term, again, not in the short term, but long term, mean reversion will happen, and it could be nasty. And let's just take a look at this chart below here. All this is the U.S. stock market versus developed stock markets outside the U.S. So we're excluding emerging markets and just using developed stock markets like Japan and Europe as an example. So if you go back to 1950, the red dashed line is what the average is, and the yellow lines are plus and minus 1 standard deviation above that average. So as you go up, it means the U.S. is outperforming. As this blue line goes down, it means international markets are outperforming. Now, I want to talk about standard deviation, for example. So I'm sure you've heard the term, and you might not know exactly what that means. Let me put it another way. 1 standard deviation will happen about 68% of the time. You will be within 1 standard deviation of that average. 95% of the time, you will be within 2 standard deviations of that average. And 99.7% of the time, you will be within 3 standard deviations of that average. So if you look here where we're positioned right now, we're almost 2.3 standard deviations away from the average. So over 95% of the time, U.S. stocks should be lower relative to developed markets. And again, just like the previous chart, that can mean one of a couple of things. Either U.S. stocks and global stocks both drop, but U.S. stocks drop a lot worse. Or U.S. stocks and global stocks go up, but global stocks go up a lot more than U.S. stocks. And they have to go a long way to just get us back near the average. What's interesting is if you go back and you've got 2 circles here, one is Nifty 50s, and then the other one is the Internet.com bubble. The Internet.com bubble only got 1 standard deviation away, and that was tech-driven. And what is everybody talking about right now in the stock market? U.S. is doing this well because we have the big technology names. We have Amazon, Google, Microsoft, and Apple. That's why the U.S. is doing so much better. We have that creativity. Nobody else can do what we do. That's okay, and that's fine. That can last for a while, but mean reversion will be nasty. I want to point out one more thing. The low for the U.S. stock market, all the way down here, which is in the late 1980s, coincided with the peak of the Japanese stock market bubble, when Japan was the pillar of the global economy and productivity, and they could do no wrong. So, and I just talked about that coincided. What's interesting about Japan is that if you go back to the late 1980s, and again, look at this bubble in the 80s on how much it's gone up. You got almost 40,000 on the Nikkei. Go fast forward 30 years, and the Nikkei is still not recovered. 30 years, it has still not recovered that bubble peak. Now, there's been ups and downs, and there's been ways to make money, but talk about from 1990 to a bottom in 2008, that's a long period of time to buy and hold and wait. And again, that came from excessive valuations. So, but we are the United States. And I understand, I'm a very proud American. This can't happen, this can't happen to us. Just like when the COVID-19 was running rampant through China, it couldn't come to the USA. It wouldn't be the same. We wouldn't lock everybody down. Well, guess what? It happened. And one of the things is, and this goes back to my point earlier, well, you can't fight the Fed because if they're printing money, it's going to drive prices higher. And Japan is old, and they don't have the Fed printing money. They're not doing what we're doing, right? Well, that's wrong. Go back to the early 1990s. This is as far back as I could go on the data. But even if you go to the mid-1990s, again, we saw Japanese stock prices haven't done anything over that time period. Look at what the white line is, the balance sheet of the Bank of Japan relative to GDP. The yellow line is the Federal Reserve relative to U.S. GDP. So you can see through the 90s, the 2000s, all the way to 2008, the balance sheet on the yellow line was relatively flat. Meanwhile, the Bank of Japan was printing money.
all the way till 2004. They were printing money. And yet, U.S. stocks did better than Japanese stocks. So it kind of goes against the point. Now, the Federal Reserve ramped up in 2008, and they continue to. You can see the quantitative easings in here, and they make little blips. Then we had quantitative tightening, again, quantitative tightening all the way through last year, while the Bank of Japan went through crazy money printing. Look at how much, even more so than what we're doing now. And people are talking about how much money we are printing now here in the United States. It pales in comparison to what the Bank of Japan has done. And Japanese stocks have done nothing. They have done nothing. So there's a reason for that. There is a reason for that. And just because, and I understand that it makes sense, you don't want to fight the Fed, there's money, and the money has to go someplace. Well, it has to go someplace until it doesn't. And that is something that I think is very scary going forward for the long term. And I'm not going to get into a dissertation. This would be for something else. If you want to call me and discuss it, we can discuss that at another time because it'll get too lengthy. But it is not, what they're doing is not productive. So we went through a lot of information. Let's put it all together. One of the things that we know is we are in a recession, and forecasting the end is virtually impossible because of the rapid descent of the data. That's part of the reason why we had a 10 million person job miss just a week ago. It's very, very difficult to forecast. Now, we know that the worst of the economic downturn is behind us in the last few months because a big portion of the country was shut down. Even if we get a second wave of the virus in the fall, and in many cases we're already starting to see a second wave in many states like Texas and Arizona, I do not believe we will shut down the economy broadly again. I don't think it will happen. So even though the worst is behind us, the growth, the returning growth, still remains a big, big question mark. Also, we have not seen any signs of classic long-term bottoms, and speculative behavior, the way people are acting, is a lot more indicative of a long-term top in market than it is a bottom. Also, short-term market moves are random. They are completely random and can be driven by a number of different factors. So the shorter time period you get, the more random the moves are. So if you go to a day, it's going to be random. Then you can go to an hour and to a minute, it gets more and more random. As you go out further, so from, not even necessarily from a day to a week to a month to a year to a couple of years, those moves become a lot less random. And they become a lot more based on fundamentals. And that's where long-term market moves are much more predictable based on these fundamental inputs. And this is why you have many of the big players, Buffett, Icahn, Druckenmiller, Tepper, who have been sitting this rally out because the risk-reward is skewed heavily towards the risk side of things as opposed to reward because of where valuations are and because of the uncertainty in what's going to happen with corporate earnings and the economy, especially over the next year. So what does that mean for looking forward? Basically, markets can stay irrational for a while, and they are irrational right now. There needs to be a breakthrough on the healthcare front in order to get the economy consistently back on track. There will be, as we have this reopening, there will be some pent-up demand. But we're not sure whether or not that demand is sustainable or not. People are going to want to get a haircut. They are going to want to go back and sit outside and have some food or a drink. They are going to want to do that. But to consistently come back and travel and get on an airplane and get on a cruise and do the things that we were used to doing just 6 months ago, you need to have a breakthrough on the healthcare front. Also, as we're coming up, the government has to extend unemployment benefits and provide more small business stimulus when it runs out in July. And they will have to continuously do this until there's a healthcare breakthrough. They have to. If they don't, this will collapse almost instantaneously. Now, what happens is, because of this, all of these actions and I'm going to go back to the Federal Reserve printing money, is actually deflationary, not inflationary, which should help the dollar and gold at the same time. And that sounds counterintuitive, and also be a drag on stocks. It sounds counterintuitive, but I'm going to go back to the Japanese model. And if you think about in the short term, when risk is off, where do people flock? They flock to the dollar and the yen. And you would think, well, the yen should go down because the Bank of Japan has been printing so much money, and that's the current argument against the dollar. Over the long term, it makes sense, but it's deflationary because this money is not being put to use productively. It is a Band-Aid to get people past this healthcare crisis in hopes that they will get productive again going forward. And I will say this, from a lot of the business owners I talked to, they said it was a huge help. The PPP was a huge help, but they're basically going to be starting their business over again when they can reopen. So again, this money is being used as a just get me past the next few months, not as I'm going to invest in a ton of R&D. I'm going to invest in new expansionary products. That is inflationary. This amount of money is deflationary. And one last part on the economy and why it's deflationary is because in order to print this money and just to put it all out there, what they have to do is they have to raise debt. And debt is deflationary because you have to pay it back at some point in time. And if all your money is going just to pay off debt, then deflation happens because it's not being used to inflate the economy. And that's why I believe that this is very deflationary, which is positive for the dollar, positive for gold, negative for stocks. And the last part about it is there is no margin for error whatsoever in stock prices right now. So unless everything works out perfectly as far as healthcare breakthrough, government stimulus being extended, and people coming back aggressively into this economy, unless all of that happens, stock prices will be significantly lower. And it can. I'm not saying that it can't. It's not out of the realm of possibilities that this can't all work perfectly. It's just it's very difficult to see it all happening at the same point in time, especially when you take in positioning into effect. So the last part we're going to talk about is what's the course of action moving forward. First off, risk management is important. We're going to continue to keep our portfolios hedged. We'll also continue to hold companies that have strong balance sheets so that they can weather this storm. Also companies that pay dividends that we think that will continue. And this is something I didn't even get into in this webinar, but we had a huge increase in the number of companies cutting their dividends. So we want to make sure that they're going to continue to pay. And then also in businesses that are not reliant on the economy to do well. So they can do well regardless of whether the economy is doing well or not. And that should help us weather the storm that I don't think that we are out of yet. Also, we're going to sell covered call options aggressively. That will mitigate risk and also enhance the income. We'll also put stop losses under our holdings and raise those stop losses as prices move higher so that we have an unemotional trigger should stocks turn lower again. And lastly, we're going to maintain uncorrelated alternative assets such as gold, currencies, or other commodities to enhance that return. Because, you know, money does have to go someplace, and when people get scared, if people get scared again, it's going to have to go someplace. And, you know, currencies and gold and other commodities could be a big beneficiary of that. So that's pretty much all I have for today. I left a lot out of this. This was a lot of information. I hope it was helpful. If you have any other questions or would like any other color or charts or anything else to supplement what I talked about today, please feel free to send me an email, give me a call. I'm more than happy to talk about it and help guide you as we go through some really, really wild times in the stock market. So once again, thanks for being on here today, and I appreciate it. And